Hello, everyone, and welcome. Thank you for joining our webinar session today. I'm Noreen Khan. I lead the European distribution team at BennBridge, based here in London. It's our pleasure today to introduce you to our emerging market long-short manager, Pembroke. Now, having reached their 3-year milestone, we're really excited to launch their UCITS vehicle for them. And this is, of course, in collaboration with Hedge Invest. Before we dive into the presentation, I was briefly going to introduce BennBridge and talk to you about our partnership with Pembroke and with Hedge Invest. So BennBridge is a privately owned multi-boutique. We have currently about 13 billion assets under management, and this is across 10 different investment boutiques. So our business model is we provide the high quality infrastructure, we provide the regulatory framework, and it really sort of sets these investment managers up to successfully establish their boutiques. And of course, we take an equity stake in these businesses. So we are true business partners in this clear alignment of interests. So with regards to Hedge Invest, I was actually, I think most of you are familiar with it, but for those who aren't, I'm going to hand it over to my peer, Laura Baldin at Hedge Invest, and she's going to walk you through the Hedge Invest platform and talk you through our partnership. With that, I'll hand it over to you, Laura.
Thank you, Noreen. So just a brief introduction on Hedge Invest for those who don't know us. Hedge Invest is an asset management company based in Milan, in Italy. The company was founded back in 2001 from the Manuli family office. So the scope and the activity of this asset management has always been on the research on alternative strategies. And in particular, the family started to invest into hedge funds back in the 90s, so in 96, and they continued in this activity via the fund of fund business within Hedge Invest. So today we have a long track record for the research into hedge funds. For this reason, in 2012, we created our own Irish umbrella fund, Hedge Invest International Fund PLC, to have the opportunity to partner up with the best hedge fund managers and create with them the UCITS vehicle, so to offer, say, their strategy also in Europe. We have five funds within the umbrella today, and we are really happy to have the opportunity to be partner again with BennBridge and to be partner with them and Pembroke for this long-short equity fund on emerging markets. We like a lot the team. We think they have a really great background, a unique risk-return profile, and so their approach to us is super interesting for the emerging markets. So we think it's a great opportunity to launch their strategy into our platform. So without wasting any more time, I'll pass it over to Sanjeev Bhatia, founder and portfolio manager for HI BennBridge EM Absolute Return Fund. Thank you, Sanjeev.
Thank you, Laura. So we're going to talk through a few different things today. We're going to talk about what it is we're trying to achieve at Pembroke, who we are, who the team is, what our backgrounds are, and then finally we're going to talk about the process and how we generate alpha and how we can generate returns for our investors. So the first thing to know is that we are an absolute return strategy, equity long short. We're trying to generate 10 to 12% returns with 7 to 8% volatility and controlling drawdowns to 7%. We're focused on alpha longs and alpha shorts. So unlike many of our peers, we are not doing a relative value or a pair strategy. We think that we get far better risk-adjusted outcomes, focusing on alpha longs and alpha shorts and using our differentiated implementation to control risk and get high-quality alpha outcomes. We use the whole capital structure when it comes to investing. So we will look at options, we will look at convertible bonds, warrants, etc. When we look at our investments. And the idea of this is to generate convex outcomes. That means to make more money when we're right and not lose as much money when we're wrong. The other thing that we look for are tail hedges. We want to protect the portfolio so that investors can sleep easy in all environments where we have strong hedging to control risk and control those drawdowns. We also aim to have a very liquid portfolio so that we can manage investors' needs. All of these things make us very different to many of our peers, and we'll go into why that is in the next slide. So this is our return profile since we launched in the Cayman vehicle. We've now hit our 3-year anniversary. We've returned 10.36% returns with a 5.68 volatility and a Sharpe ratio of 1.8. You'll notice that we have a very low beta to markets and a very strong alpha. So this is exactly what we're looking for. We want to be low net, uncorrelated, controlled drawdowns, high quality alpha generation. If you go to the next slide. Thank you. What we provide to investors, and we have a broad range of investors from long only through hedge fund investors, absolute return investors, long short investors. And what we provide to all our investors across this range is the ability to improve the risk reward of your portfolio. And what this chart shows is, as you add Pembroke to our portfolio, you move from the bottom right to the top left, you're reducing the volatility and increasing the return profile. And this gets people closer to an efficient frontier. Good, slide 7. So who are we? My name is Sanjay Bhatia. My partner on the call today is Greg Mariash. We've both known each other for over 25 years. We spent a lot of time at Goldman Sachs together, running emerging market trading. I was based in Asia. Greg was based in New York, where he ran LATAM and EMEA. I was in charge of Asian equity. And those experiences over the years have fomented our view on it and our philosophy on investing. Greg left Goldman in 2003 to join the Rohatyn Group, which is a multi-strategy hedge fund. I left in 2004 to join Deephaven, which is also a multi-strategy hedge fund. We've had various roles since then. My most recent role was to run the emerging markets portfolios at the Harvard Endowment. But this strategy, and when we go through the process, you'll see is the culmination of our 25 plus years of experience each in emerging markets, understanding risk, understanding when to take risk, and understanding how to extract returns. We're joined on the team by two, again, very seasoned and experienced analysts. One is Luis, who is focused on Latin America, Spanish by origin, and comes with a private equity background. And we have Jun Choi, Korean, focused on Asia, but also comes from a background of tech and supply chains. And what we feel is that what this gives us is a broad diversity of thought. It's what we call cognitive diversity. Everybody is incredibly seasoned and experienced. Between the whole team, we have over 80 years of investing experience, and everybody brings something to the table. We take a very consensual approach to investing. We debate every idea across the whole team, lots of discussion, and it's the ideas where everyone feels they'd wish they'd thought of that idea. They want to own that idea. Those are the ones that make it into the portfolio, and that we think gives us great idea vetting and great idea distillation to get to the ideas that we think are the really high conviction ones. With that, I'll talk about our process and what we do. So we are at heart bottom-up stock pickers. Stock selection is step one of our portfolio. It's what we do day in, day out. It's the starting point of our process. And really here, we're trying to identify alpha longs and alpha shorts. As I mentioned earlier, we're not doing a relative value or a pair strategy. We think by doing alpha longs and alpha shorts, we get similar return outcomes for far less risk and far less idiosyncratic risk when markets, natures behavior changes, and portfolio behavior changes. We have far less exposure to those changes than a relative value or a factor neutral strategy. What makes a good alpha long and what makes a good alpha short? If you go to the next slide, sir. So on the long side, we are looking for companies that have a sustainable edge and can generate an excess return on capital. What gives a company an edge? There can be a lot of different things a company can have as an edge. We look for strong intellectual property, for example. So we invested in a company in China called CATL, which is a battery maker. They have the best intellectual property around battery for vehicles in the world, and we think they're world-class businesses, and that allows them to earn excess return on capital. We like things like monopoly assets. For example, airports, toll roads, 5G towers, railway infrastructure. These are businesses where it's very difficult for new competitors to come in. If you have an airport, it's very hard for someone to come and buy an airport, to build an airport next to your airport. And so they have a moat. And these assets, as long as you are in the right countries, jurisdictions, governance, have the potential to generate very strong IRRs. We like businesses that are in growth industries where you have a GDP, a multiple to GDP natural growth in your business environment, and then you have a strong market positioning that allows you to exploit that growth. So for example, in e-commerce, we have core holdings in a company called Mercado Libre in Latin America, in Alibaba in China, but we also have holdings in travel, airports, airlines, insurance, etc. So healthcare insurance, property insurance, and all of these industries are growing at multiples of GDP. For example, over the last 10 years, travel in emerging markets has grown at double GDP growth. When you find industries with strong growth and companies able to exploit that growth and have the operating leverage, they can earn that excess return. We're also very focused on innovation. We like companies that are solving people's problems, whether that is next generation fuel cells for electric vehicles, fintech to open up the banking system to unbanked people, healthcare innovation where you are improving people's lives or giving them access to healthcare online or virtually. These are all areas that we think companies are solving people's problems and hence can earn that excess return on capital. On the short side, we look for companies in industries that are facing structural challenges. So we're looking for companies where there's low growth, where there's disruption, where there is high competition, and also industries where there are very high capex needs with no visible gain in ROE. To give you a prime example of that, we've had structural shorts in the auto industry since we launched 3 years ago. If you think about what's happening in the auto industry, it's incredibly competitive. There are 30 different manufacturers competing globally. You've got sales that have been lackluster growth in sales, new disruptors coming in with Tesla and the new Chinese EV makers like NIO, Li Auto, XPeng Motors, Baidu, etc. And the legacy automakers, whether that is someone like a Hyundai or a Kia Motor, have very high capex needs going forward to compete in this new and changing landscape. And it's not clear to us that they'll be able to generate the ROEs required to justify the capex that investments they're making. So I hope that gives you a good understanding as to how we find our longs and shorts and what we're looking for. I'll hand over to Greg to talk you through the next steps of our process.
Thanks, Sanj. Sarah, if we can go back to page 8 on the process. Right. So once we have the base of our investment process covered, which is our stock selection, and that is the most important part of this process, we move on to steps 2, 3, and 4, which will eventually conclude with us having a portfolio that we feel is well structured in longs and shorts, but also resilient to what can be happening in global market and financial conditions. The second step of the process now includes saying, okay, I have my longs, I have my shorts. What kind of investment tailwinds or headwinds are being created by being in the countries where they are? So for example, we can have a very high conviction long stock idea, but that company can be in a country where for some reason, the political situation, the industry situation, the economic social situation is providing some kind of headwind. So that means that we have to start thinking about how we're going to size that position. We may like the company a lot, but there may be a series of issues that is affecting the completion of the investment strategy, the business strategy that the company has. So when you put it together, and let's move to the matrix on what that yields, we end up with a 4-quadrant matrix that is basically telling us we have found good companies in good countries, and that's the upper left quadrant. That's a high conviction long position for us. We will have found bad companies in bad countries, and that is a high conviction short idea. What do these mean? It means that as long as we have other conditions such as liquidity, the right vehicles, availability to go short, and we're basically, especially on the short side, we've done more analysis in terms of what the short interest already is, etc. Those are positions we can feel comfortable sizing to the maximum of our conviction and the maximum that our investment process permits. Where we have to deliberate a lot more carefully is when we find a good company in a bad country, because that's where those headwinds will basically muddy up the investment case. And situations where we find a bad company in, a bad company in a good country, because what you will have is passive inflows, meaning that regardless of whether the particular business case of that company is bad, you may get passive inflows of people that are investing through ETFs, people that are investing because a country has been determined to be good, that may provide a bad situation in a short position. So if you go back to the pyramid that we have in the investment process on page 8, we will have concluded the 2 steps of our investment process, which we call the knowledge edge. That is our stock selection based on the characteristics that Sanjeev has laid out, the country analysis, where we determine whether we're facing headwinds or tailwinds on the investment case in each of these particular stocks. Let me clarify one thing. A lot of times when talking about investing in emerging markets, it delves into a conversation about macroeconomics. What we want to point out is we are a stock picking fund. Our core process is long stocks and short stocks to generate alpha. The country analysis that I just spoke about is purely helping us size our positions depending on whether the country where this stock is based and the particular situation surrounding the industry or the relation of the company with the country that we're analyzing is giving us, right? Once we have our longs and shorts, and once we have our conviction in terms of how large we would like to have these exposures, we move to implementation. And this takes us to the part of the process that's called the structural edge. When we implement, we're starting to look at that, trying to give the portfolio that convex nature that Sanjeev has said, and which results in making more money when we're right and having controlled losses or drawdowns when we're wrong. So this includes everything from valuation, which may be one of the main characteristics of building a convex portfolio, meaning that the valuation is giving us enough margin of safety that we're happy to take a position in the straight equity without having to worry too much about the downside. If we're able to find other forms of implementation, such as using the volatility markets, using other parts of the capital structure, then we will analyze those, and those have to have certain characteristics. If we're trading in the options market, it has to be a liquid listed options market. And if we're using other parts of the capital structure, it has to have the same liquidity profile as investing in straight equity. Otherwise, we're not going to do it. What that ends up is a portfolio that is generally going to fluctuate somewhere between 60 and 70% with straight equity ideas, straight longs and shorts on the equity securities, and 30% of the portfolio on average, 30 to 40% of the portfolio on average, which will have other forms of convex implementation, which is giving us the equity exposure, but is protecting us from the downside. That as an illustration of what that gives us, if we move to page 11 of the deck, This is the analysis of every position that we've taken since the launch of the Cayman Fund in April 2018. We've had 200 winners, 148 losers. That is a 57% hit ratio against a 43 loss ratio. The average winner, though, has contributed 26 basis points to the portfolio, where the average loser has contributed 10 basis points. So that gives you, when you look at this chart, that very long right tail and a very, very compact left tail. And that perfectly illustrates the type of convexity that we are trying to achieve. Not shown in the slide, but also of interest, is when we break down the cohorts, meaning how does this work in our long stock selection ideas and how does this work in our short stock selection ideas, we have a similar, lower but similar profile on the shorts, meaning that with shorts, we have 53% winners, 47% losers, but the winners are contributing more than the losers to than the losers take away. So the convexity implementation is basically working both on the long side as well as working on the short side. Now, steps 1, 2, and 3 have now yielded a portfolio of long ideas, short ideas. The country analysis has helped us size these ideas. The third part of the process has helped us build convexity into the portfolio. In an ideal world, that's where the process stops. But our experience has told us that's not the way things work. So if we go very quickly back to the pyramid with the investment process, our final portion of the investment process is our risk assessment, saying, okay, what can happen in global markets, global finance, global economics that can make this portfolio perform in a different way that we have anticipated after concluding steps 1, 2, and 3. And for these things, we look at macro variables such as oil, interest rates, US dollar, which have been traditionally the 3 macro factors that have affected the fate of emerging markets, different effects in different times. And that goes back to marrying the country analysis with what's happening in global finance and economics, and thinking, okay, now that I've done this, what can we do to protect the portfolio? And in general, what we'll do is try to find hedges that will, if one of the negative outcome scenarios that we think could take place, such as an oil rally, such as a exacerbation of the trade war between the United States and China, sudden jump in interest rates, which is very, very important to emerging markets, sudden revaluation or devaluation of the dollar versus the EM currencies, we will apply hedges that will permit us, when these things, if and when these things happen, to have enough time to evaluate the portfolio and say, okay, which of these things, which of the trades that we have on is no longer feasible? And is that a temporary situation or is that a permanent situation? For example, COVID made a lot of the strategies or some of the strategies that we were looking at, such as travel and tourism, be temporarily impaired. And we can talk a little bit more about that in the Q&A session if anybody's interested. So that is the conclusion of how we build a portfolio and how we risk manage the portfolio. So I'm going to end here. Give it back to Sanj if he wants to have some final comments on the investment process.
Sure. Greg, just to add one more thing on the investment side is that we're not just looking for events that are negative to markets. We're also thinking about events that are positive for markets that may cause a very big spike in markets or a rally for as people pile in because of some sort of structural change that's happened. So whether that is interest rate cuts as well. So we're trying to hedge both the left tail and the right tail of risks for the portfolio because both of those are a change in behavior of the marketplace, and that's really what we think about when we're looking at those things. The other thing I'll add, if we just quickly jump to slide, I believe it's slide 9. No, sorry, hang on, just 1 second. So slide 12. is just how we think about that risk. We run a lot of scenario analysis. We'll look at historical scenarios, so we can go back and run the what happened in October 08, what happened with the taper tantrum, what happened in March 2020. We also can run our own created scenarios, so we want to think about what shocks we're envisaging, how they're going to manifest themselves, and what the behavior is going to be. And we can take all of those things into account when we're thinking about these tail risk hedging. So that concludes the presentation. Should we open up to Q&A?
Yeah, maybe just before going to Q&A, we already have a couple of questions. I think it's important just to point out how you would translate the hedge fund strategy for the UCITS strategy, if there were going to be any major changes to your approach or not. So.
Okay, so we're going to be using exactly the same approach and exactly the same instruments as far as we can. There are some differences in implementation between UCITS and Cayman because of some of the restrictions in UCITS, but shorting is going to have to be done on swap because UCITS doesn't allow you to short outright. There's some cash management rules. Obviously, the UCITS fund is in euro and not in dollars, so there's some slight difference there, especially in funding rates, given the difference between euro interest rates and dollar interest rates, etc. But overall, we expect very little slippage between the two.
Cool, thank you. So we already have a couple of questions, but then we open up for everybody who wants to ask. So one of the questions is interesting, even if we are happy with your ultimate decision. And the question is, why did Sanjeev and Greg decided to team up and not launch on their own, given their high pedigree background?
Well, I think the main reason for that is that Greg and myself both have been investors for many, many years. We love looking at companies, understanding markets. We love investing. We don't love running all the other parts of the business that's involved in it. I mean, that really is, we've been doing this long enough to know that that is not our core expertise and is not our value add. I really don't like sitting in meetings where we're going through what's the policy going to be on which telephones we're using and things like this. So, having the operational aspects handled by high quality institutional level partners for us frees up our time so that we can focus on the things that we love to do. So for us it was very important to find the right partner with the right incentives to make sure that this works in the right way, and that's really what we found with BennBridge. Greg and myself are 100% responsible for the investments. We're 100% responsible for the investment process, implementation, etc. BennBridge is 100% responsible for all of the infrastructure, legal, compliance, everything else. And it's a very clean separation. There's really no overlap. And what it gives us is just a very clean boundary of what we do day in, day out versus what BennBridge does for us day in, day out.
Yeah. So the next question is more on the market. So the question is, were you able to achieve convexity in the portfolio in Q1 2020? Cautious that it was a rocky quarter for emerging market. It would be interesting how you did it.
Sure. So Q1 2020 is a prime example of how we are focused on tail hedging and controlling risk in the portfolio. So if you think back to the beginning of Q1 2020, we were fully risk on because, so if you go back to that slide 12, we can talk through how some of it was relevant. In our portfolio, we were fully risk on because all of the macro indicators that Greg mentioned earlier were all pointing to risk on. So oil was $60, which is a very neutral level, doesn't hurt producers, doesn't hurt consumers, everyone's sort of happy. The Fed had been cutting interest rates, QE was increasing, there was plenty of liquidity in markets, the dollar was controlled, and not causing any financial stress. And China and the US were in the process of signing the phase 1 trade deal, which was alleviating the pressures that we'd seen in 2019. So from our perspective, when you think about scenarios and what factors could change the nature of markets, it's very difficult to identify anything that could cause financial distress. And the fact that we couldn't identify any factors also meant that the markets were very comfortable with risk, and volatilities were incredibly low. Our approach is to really think about these scenarios, and the fact that we couldn't come up with a scenario was really scary for us. Our view was that the only scenario that we could see was the unpredictable scenario where some exogenous shock that we haven't even thought about hits the global economy, correlation goes to 1, beta goes to 1, and we have a big drawdown in markets. That was the risk that we were worried about without knowing the catalyst. Because markets were very comfortable with risk, we were able to buy tail hedges to that risk in January 2020 at incredibly cheap prices. So we were able to buy index options on emerging markets, which is effectively that correlation hedge, at about a 13 vol. These are generational lows in volatility. So we had never, in 30 odd years, we'd never really seen volatility that cheap. And so we implemented a tail hedge by buying very short dated options for very little amounts of money. We're talking a few basis points a month. And when COVID hit, those hedges really came in to protect the portfolio. So we didn't know COVID was going to hit. We didn't have any advance warning. It's just part of our process to worry about risk and what can go wrong, and try and protect against things that could go wrong. And what that meant, to answer the question more directly, is that we ended up making money in January. We ended up making money in February. We lost 88 basis points in March. And one of the things that allowed us to do, as Greg mentioned earlier, is to really do a deep dive into the whole portfolio, by March, having had a good understanding of what COVID meant and what the impacts were, and readjust the portfolio to what we thought the new future path of markets and investing was. So what that meant was that we reduced our positions in travel and tourism. We increased our positions in e-commerce and automation, and really adjusted the portfolio. But we were able to adjust the portfolio without being in a fire sale. It was that tail hedge that provides the cushion. That means that we can then take a rational, stable approach and really work through each position and work out what we need to do, rather than just saying sell everything and rethink about everything. And that's really the benefit of having that tail hedge strategy.
In this respect, Sanjeev, is the long book independent from the short book, or do you work with pair trades also for this convex part of the strategy?
So as we've kind of said in the presentation, we're looking for alpha longs and alpha shorts. They are independent ideas. We are not doing pairs trades. We don't go, oh look, I want to go long a stock in this industry. I need to find stocks in this industry to go short. We will have industry, country, sector mismatches in the portfolio. So we are not relative value, and we're not a factor neutral. But what we do, but how we compensate for that, is that because we are alpha long and short outright positions, we can take slightly smaller positions because we're not paying for those relative value hedges. The other thing we do is build convexity into the ideas, whether that is valuation, derivatives, optionality, etc. We build convexity into the individual ideas, and that acts as a risk control. And the final part of it is the tail hedging that gives you the aggregate portfolio control. But we're not sitting there trying to be factor neutral or sector neutral in everything that we do.
And in terms of cost, how much does it cost, the protection and the convexity book?
So we don't look at it as a cost. We look at it as an integral part of the investment process. So the way we think about it is that we want to build convexity in an accretive way. So when we look at step 3 and our implementation, we want that implementation to be the best implementation that there is. So inherently, what that means is that the cost of that implementation, the way we implement, is done at the best cost implementation. So we don't set a budget because we're only implementing in a way because it makes more sense than implementing in any other way. If that hopefully that makes sense.
Yeah, so let me add, that's why we make the distinction that steps 1 and 2 is a knowledge edge that we bring, and steps 3 and 4 are a structural edge. Meaning, you know, we can know a lot, but if the market is not giving us those structural opportunities, then we can't implement in a more convex way than what they're letting us do. That's a very big distinction between these 2 edges. Now, having done this for close to 30 years, those structural edges keep popping up over and over and over, and sometimes they're fleeting and need to be taken advantage of quickly, and sometimes they're there for a while. The example that Sanjeev gave in terms of how we navigated through the first quarter of 2020, that was a structural edge. That permitted us to buy hedges that are some of the cheapest hedges that we've implemented throughout our careers on a relative basis, because it was there. But if it hadn't been there, we would have had to look for other things.
Another question we have is, how do you manage the net exposure? So what's the typical range of exposure for the fund?
Greg, do you want to?
Sure. So by design, the strategy is we call it low net, and for us that means going from plus 30% on the long side to minus 30% on the short side. And the way we manage it is, and we also, as a differentiator to some of the strategies out there, we also manage our gross exposure very aggressively, meaning that we don't feel that we have to be invested at any gross level at any time. That is not what we feel comfortable with in terms of what the market is giving us. The opportunities that we have identified on the long side and short side of each individual company that we've selected, as well as the portfolio and the convexity that we can build around that. So on the slide that's on the screen right now, these are our guidelines, about 30 to 50 long positions, 15 to 20 short positions at any given time. Top positions will represent about 40% of the book, both on the long and the short. The holding periods where we find that we have the highest hit ratio is 6 to 36 months on the long side, 3 to 12 months on the short side. We cap ourselves at a 25% sector exposure, 25% country exposure, and as I pointed out, 30% net, either long or short. Gross will range on average somewhere between 100 and 200. But to give you an idea, in March 2020, we pared back that gross exposure to somewhere around the 70% level, given the uncertainties that were prevailing in the market. Our experience has told us one of the best convexity or one of the best protections that you can embed in an emerging markets oriented portfolio is to be liquid. You don't want to get stuck with something that you can't sell at the moment you're trying to sell it. Or you don't want to have a very difficult implementation position of a long trade either, because the prices get affected. So this is something we've run by our outside independent risk consultants. We did it for the Cayman Fund. We did it for the UCITS Fund as well. We can liquidate 90% of the portfolio between 1 and 5 days.
Thank you. Yeah, we have many other questions, so I'll try to put them together. So one question is, what currently worries you on the markets? And the second question linked to this one, how could the antitrust in China policy impact your strategy? So if you could address both of that.
Shall I start? I'll start with the antitrust first. The antitrust has already had a significant impact on markets, especially in China. So we've seen it with Alibaba, we've seen it with JD, we've seen it with Meituan, etc. so the derating in these companies is now at a point where something like an Alibaba is at a generational cheapness. So right now there is a lot of convexity in those ideas, in that the valuations have already priced in a difficult time ahead with this antitrust. So if you look at the example of Tencent, which went through a similar process of the government cracking down on Tencent's businesses back in 2018, 2019, this was a process of around 12 months where Tencent was, dragged over the coals. There was a significant derating. The stock became very, very cheap, and has now returned back to being, getting back to a fairer valuation. So, I think the big impact of the antitrust, which is the no antitrust to being some form of antitrust regulation and crackdown, we've sort of seen that already happen, and the valuations have gone to a point where we are now at generational lows in valuations for these companies.
That's where that second part of the process really kicks in, right? Because it's the country analysis that I referred to, the particular relationship of the country with the sector, meaning so the crackdown has basically been on companies that are gaining too much power in China, and that can be through market. It can be through the combination of businesses. So one of the things we like about somebody's there's been a question as well as I believe on how if we can explain the convexity process on a stock selection and take it through there. In 2018, we were slightly up, where in the emerging markets had a 15% drawdown. The main reason we were able to do that is because we identified the risk in China at the beginning of the trade war, as well as the crackdown on what were considered to be powerful groups. And that affected our view, not on China, because again, I can't stress enough that we do not do country selection. We don't say China's looking good, and then we go in and try to find Chinese companies to invest in. We look at companies, and then we say, what's the relationship of the company with what's happening in the country? We were able to stay away from sizing our China positions in any way that would hurt us in 2018, while all this was going on. That 15% fall in emerging markets was largely driven by China, because China is a very, very big component of the emerging market index. So that's how we look at this. There's also opportunities that get offered, right? Because a lot of the times when you get these crackdowns, what's going to happen is the market will rush and sell these names, and either through a direct purchase of the underlier, if we happen to like the company, or a convex opportunity that may show up in some part of the capital structure or in what's available in the options markets, gives us a very, very good entry point with a lot of convexity. And that happened recently, for example, with Baidu, when there was a portfolio in the market that was doing a very, very heavy liquidation, which took Baidu to intraday lows that, if you look at a daily chart, doesn't show up, and permitted us to set up call spreads with very, very favorable upside, downside payoffs. And that's that structural opportunity that I'm talking about.
Maybe just another couple of questions, very general questions. So how do you split up the responsibility between the two of you, and how many stocks do you follow in the universe?
Sure. So look, we take a very consensual approach to investing. Everybody on the team has a say in what is in the portfolio, can ask any question, and we often, grill each other on the thesis, on what's going on at the companies, why does this investment make sense, etc. There is a lot of debate, and that is all part of the process. That is why we have seasoned and experienced people on the team. We're not just hiring MBAs out of college and giving them a list of questions and saying, go and talk to this company. We want people with experience who know what the right questions to ask and can go and ask them to the management. So the way that the team operates is a very consensual approach. We debate all of the ideas. Ultimately, I make the final decisions as to what goes in the portfolio and how we size it and all of those things. But if we can't get agreement within the team, and Greg's got 25 plus years of experience of looking at things, in EMEA, Latin America, Asia, etc. If we can't agree, we generally won't do it. Won't do that investment, because clearly the fact we can't agree means that there is some knowledge edge. Coming back to our steps 1 and 2, there is something in that process that doesn't allow us to get to an agreement. There is a missing piece of knowledge, and if we can't fix that piece of knowledge, we can't find that piece of knowledge, then rather than making a bad investment, we'd rather just not make the investment. So in general, ultimately I make the final decision, but unless we are in agreement, we generally don't do anything.
And the last point was how many stocks we monitor.
So look, the index itself has about 1,200 stocks, but there's a lot more than that globally. We think our investable universe is about 3,000 companies. We don't monitor all of them because we can't. That's not what we're trying to do. We're not trying to be a research department that has an opinion on every single stock. What we're trying to do is to find 30 to 50 great long ideas at any given time, 20 short ideas at any given time. To do that, we run a lot of screens. We'll run screens on inflection points on earnings, EBITDA multiples, performance characteristics, factor analysis. We can run all of those things. But the thing that we do where we think it really provides the edge, really differentiates what we do, is meeting managements and talking to industry specialists. And between the 4 of us, we do about 600 to 800 of those a year. So we will be on conferences. Once travel can restart, we'll be face to face. But you go to a conference and you can do 30 companies in 4 days, etc. And all of that is about building that knowledge edge. When we talk to managements, we want to understand, what are they worried about? What are they scared of? What do they see as their opportunities? Why do they think they can make great ROEs going forward? All of those questions, we build that knowledge edge by talking to the managements. Screens can only get you so far. And we think the real differentiation is when you talk to the managements and understand what it is that they're worried about. I'll give you an example. I went to China during the middle of when the whole trade war issue was kicking off, and I spoke to many CEOs about, what are you scared about with this trade war? And the one thing that really kept coming up again and again is, they were very confident in China's ability to withstand the trade war, apart from semiconductors. And the big weakness in the whole Chinese model is that they're not self-sufficient in semiconductors, and they rely on the Koreans and the Taiwanese for all of their semiconductors. And that takeaway was really incredibly important in forming our long semiconductor structural view that we've had for the last 2.5 years. And now you're seeing that play out with the chip shortage and all of these other things that people are talking about. But we've had this view for 2.5 years that the key component, the key bottleneck between this US-China tension and winning the future, if you want to call it that phrase, winning the future, who's going to win the future, that semiconductors are going to play the core pivotal role in that, whether that is 5G, artificial intelligence, automated vehicles, automation on many different fronts. That semiconductor battle is going to be is going to be the core issue. And hence that's led us to making very strong returns in the semiconductor space over the last 2.5 years. But that's what you get by actually building that knowledge edge.
Perfect. So I think we pretty much covered all the questions. Before ending up the webinar, I believe it's important to underline that we have an initial share class for the fund with, say, convenient terms with respect to what will be standard after we reach the first 100 million. So as for this slide, we are going to have this initial share class with management fee of 0.75 and performance fee of 10%. Liquidity, daily, 1 day's notice for subscription and 5 days notice for redemption. Said that, I think we thank you very much to the team, to Noreen. I hope we were clear in explaining the strategy. We will send over to all the participants the recording, but also the material, and we are very available for any question.
Thank you very